The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group. We welcome you to our radio podcast, and we also welcome our co-host this week, Alex Monk, certified financial planner from Akers Financial Group. Good morning, Alex.
Brian, it's good to be here.
I'm glad you're here with me today. Yeah. We have a very, very important topic, but at Akers Financial Group, the client is always our most important topic. So one of the things I wanted to mention as we begin the show is this. If you ever think about financial services company and what their biggest assets are and what's the most important thing, at Akers Financial Group, I want you to know that the most important thing is the client, taking care of the client. And that leads us to our topic today. And that topic is the idea of how to work and use a Roth IRA, a Roth 401k. And we want to teach you a new word called Rothification. Not sure if it's a legal word yet, but it will become one.
It is. It is legal.
It is. You know that for sure.
I mean, is there... I don't know what makes a word illegal.
Well, official, I guess, it might be a better word, right? Rothification. So what happens is this. When you're thinking about this, you're driving around or wherever you're at today, listen to the show, what happens is this. Roth IRA, how does it apply to you? And have you been Rothified? Have you Rothified anything? Have you done any Roth in your portfolio? We want to talk about how to do this.
So what is a Roth? I mean, I hear a lot of people call them and they're like, hey, I got to get me a Roth.
Yeah, well, let's go back to 1998.
Oh, gosh.
And Bill Clinton was president, and then you had the Republican Congress led by Newt Gingrich. And then there's a senator from Delaware, the last Republican senator from Delaware named Alan Roth, R-O-T-H. He sponsored this rule where one of the ways to balance the budget, which that was the last 2 years of the government actually balancing their budget.
Wow, so this is like way back.
1998, yes. So that's when this started. So the idea was this: pay tax now on your IRA money, your money that's been pre-tax, money that you deducted out of your paycheck, you pre-tax it, pay tax now, and let that money grow tax-free the rest of your life until you need it. And so the idea of Roth was created by that concept.
Yeah, get money now.
And so the government gets their money now, right? And so even in 98, what they did is you could spread it out over 4 years, pay your tax over 4 years, but that allowed people to do larger sums of Roth. At 97, 98, the markets had their downturn, so it became a really great time to do my first Roth conversions. They had other rules where if you didn't like what you did, you could recharacterize and fix it.
Yeah, those were the days, and you had like a year into the future to go backwards.
Yeah, that rule's gone. Yeah. So whenever you do anything called Roth conversion, you have to know that when you do it, it's done. You can't go back on the deal of Roth conversion. All right, so we have different terms that just dropped. So, Monk, you got to define...
David Allen Roth.
David Allen. Yeah. I think that's a rock singer, David Lee Roth.
Yeah.
That's not the senator.
Delaware Roth,
Allen
1990s.
1998.
Okay.
Yeah. But the Roth IRA, the idea is you pay tax now. Money goes into this Roth IRA. It is the custodian. It's the title of your account. Roth IRA for the benefit of you. That Roth IRA has rules. It grows tax-free for qualified withdrawals.
That means rules.
The rules are basically 59.5, and if you had the account more than 5 years, you can get the money out.
Now, 5 years from when you open the account. Now, is that any Roth? Like it's your
January,
first Roth.
January 1st of the year that you did your first Roth.
Yeah, your first one.
So
right?
you do have to keep paperwork saying, "Hey, I did a Roth in 1998," just in case they audit and say, "Oh, this is a new one." Aha, we got you.
Yeah, especially if you're like right on the bubble there.
Yeah,
I would write it down.
Now, over the years, they changed the rules, and we have our current rules today. So I'm not going to go historically and tell you all the rule changes, but the idea is this. The concept of Roth, or if you see the Roth option, that means you pay tax now, and it grows tax-free for qualified withdrawals. What's some qualified withdrawals there, Alex?
59.5, over 59.5 is all qualified if you had it for 5 years. So
Any other ways you can get your money out of Roth?
You can take your principal out.
All right, so whatever you put into a Roth, you can pull out, as long as you track that on your tax form.
Oh, which one? The 8606? Are you bringing that up first quarter?
Wait, we're teasing it first quarter.
Wow.
And then fourth quarter, we're going to bring it home and really explain the 8606. So you got look forward to that. That's exciting.
Yep, new words and numbers today, folks. 8606
is a form that if you're a Roth person or after tax contribution, you got to track this basis so the IRS knows what you did.
Yeah, and it's really important too, because like on that form, there may be some information that will allow you to not pay tax twice.
Absolutely. If you don't do the form, you pay tax twice, but that's later. We'll cover that more. Basic Roth IRA, qualified withdrawals. There are ways to get your original principal back if you need it. So it's a great way for younger people to put money in and to get that money back out.
Right. So what you're saying there, when we say put money in, we're talking about contributions.
Yes, contributions are money that you can put in if you make under certain limits.
Okay.
You're allowed to contribute to a Roth IRA.
So you have to make under a certain limit, but
Yes.
you have to make something.
You have to have earned income. And so what happens is one of the years they opened it up to where no matter what age, you can still put money into a Roth IRA. So we do a lot of Roth IRA contributions in January for people that work part-time in retirement.
Yeah, they come in here with their W-2 and they're like, Alex, I got $4,523 I can put in my Roth.
Yeah, and what that means is we can shift money from your bank account into a Roth IRA and make it tax-free.
And like the biggest thing here is that tax-free forever.
It's tax-free for as long as you live, and then 10 years for your kids.
Right, but for your entire life. So for me, it's for forever.
Yeah, I mean, some people do live forever in our hearts. The sad part is we do pass away, and Roth IRAs can go to a spouse and stay tax-free. But when it goes to that next generation, they'll have a 10-year rule limit on taking that money out. Roth IRA, Alex Monk, this is the question. What can they invest the money into?
You tell me. Anything you want.
I'm asking you. I'm not telling you. You tell me.
Well,
come on now.
So like you said,
Let's go.
3 minutes ago, you said the Roth is just in the titling.
I know, but what can I buy? What can I invest in?
So wherever you have that account, you know, if it's at a bank, you can do whatever they'll let you.
You can buy money market, savings,
CD, cash.
What happens when you see someone doing that?
I feel a little upset.
And why you're upset?
So in my brain, the Roth, right, it's this like golden goose, right? We want to protect this egg, let it grow.
Let it grow, yeah.
Till the very, very end, or to pass it on, right? So I always have that money allocated as our most aggressive.
Okay, so you're saying most aggressive, meaning that you would buy what?
I would probably be in some type of stocks,
All right.
some type of risky asset that's going to have an above inflationary return potential.
Because the goal is to grow the money tax-free. If it's in a savings account making 0.001 or 0.01, you end up not making any money, so why is the Roth there?
You don't make any money, there's nothing tax-free.
Yeah, I tell people, like, well, if you have money sitting in the bank paying taxes, you can retitle it as a Roth and move I guess limits are based on people under 50 and over 50. And then in 2025, there's this cool rule of a little bit extra you can put in. But you're not going to cut. That's not the goal of this show today.
Yeah, you're flashing forward on me, man.
Yeah. The Roth IRA is really a key thing that people need to understand. So imagine this. You take a little pile of money and you pay tax on that. You let it grow to a lot larger pile of money. And then you don't pay tax on that. That sounds good, right?
Well, but Brian, when I started saving to my 401k or all my pre-tax stuff, they said I'd have lower income in retirement. That's my number one.
Yep.
That's like the go-to myth out there.
And my response to that is, do you really want to be in the lower tax bracket in your retirement? Do you realize that means you don't make the money you're making now? It means you're going to have to live off a lot less.
A lot of times what I'll do is I'll project out their income and show them like what things look like when they're going to be 75.
Yep.
And I'm like, you're going to make more money when you're 75 than you ever have in your entire life.
And that's why if we can get it to Roth, get as much as we can to Roth, at least that's tax-free. And then things like employer matches and other money that comes in is always taxable. You can't really get away from that yet.
Right. And the goal is not to essentially or necessarily get everything you got to Roth, but it's building that balance, right? So we're going to have pre-tax money, after-tax money, Roth money, and how does it all play in? But, the more sources or different buckets of types of money we have, the more creative we can get.
Yes. So what's amazing is that Roth didn't just stop with a regular IRA. They started to allow us to do Roth inside of our 401ks or TSPs.
Right. And that doesn't have the same income limits. So
yeah, no income limit. And you can put all of your contributions into that. So if you're over 50, you can do like 30,500 into that.
Right. But if you're doing 30 grand pre-tax,
yep,
you're probably only taking like 20,000 out of your pay because of the net tax benefit. I don't know, some math like that.
Correct.
Well, if you do 30,000 Roth, you're paying the tax on top of that. So you're really putting 50 grand, right? I mean,
I was thinking more in the 40 range, but 38.7.
But more.
But more, yes. Well, you end up paying the tax now, which means you have less bring home pay. So Roth IRA, Roth 401k, especially Roth 401ks, is an investment in your long term. You're basically throwing money to your future self. And guess what? There'll be a day when you get to catch that money tax-free and be very thankful. You'll actually say, I like my younger self because of that.
Yeah, and, I don't know how budgeting works for the government anymore, but based on what I've seen, they should probably increase taxes.
Or cut expense. That's the only way you can do a budget. You have more money coming in, less going out. But we'll have to see what government likes to do, see if they ever become more efficient or whatever happens. So the key ingredient in this is a Roth IRA. We need to get to know a Roth IRA and how to apply it to your life currently. That means if you're younger, if you're middle-aged, if you're older, getting close to retirement, you're older and are retired, Roth can still be a viable option for you. That's what good planning should do. At Akers Financial Group, we're local, we're independent. We don't report to a big company on Wall Street. We report to you. We look after what you need to do in our offices in Lutherville, Forest Hill, or we meet on the Zoom or
on
whatever.
The line.
Online?
On the line.
On the line. I'm not really up to the cool words yet, but we see clients all around the Mid-Atlantic region, all around the country, even a few around the world. It's so easy to begin winning in retirement. You just give us a call and schedule your free meeting with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. Why the Roth? Pay taxes now? That may be your best long-term plan. We'll explain in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. Welcome to the second quarter. This is Brian Akers from Akers Financial Group. Here with me today is Alex Monk. We've been talking about Roth IRAs and the word Rothification. And what we're going to be talking about this quarter is a very important topic. But at Akers Financial Group, we believe planning is always the key. And so what we got to do with Alex Monk is really just dive into Roth IRAs. And then we want to talk about the idea and the new word Roth conversion.
Have you ever heard two people so excited as we are to pay tax? Like, most people are probably like, I was just listening to something and they're going to say pay less tax.
Well, if you're an accountant, the accountant is like keeping score of last year, and their goal is to get you the most refund, the least amount, and they're not going to be the biggest fan of Roth because they're looking at that one return. They're trying to win on that return. Yeah,
and I've gotten in a lot of arguments with those, I'll call them tax preparers or whatever they are.
Yep.
And it really is, I know it's cliche, but it's about each person's situation.
I talked to an accountant just a week ago, and her comment was, that's a future me problem.
Correct.
So it's like, I want to pay less tax now for me. Future me will pay the tax, not me today. and I try to explain, it's the same person here.
Right.
And the thing is that if you pay tax now and never again, that's a Roth IRA. Pay once and never again. Let that thing grow. The younger you are, you can get the compounding, the growth.
You sure you just don't want to ignore it until it's too late and you can't do anything?
That should have been my response is, hey, let's ignore everything and just let the future me worry about it.
Well, I mean, we are worried about the future me because what we're trying to do in having you pay the tax now is have lower lifetime taxes.
Lower lifetime taxes means you keep the money. It's your money.
More money in your
More money. And guess what? We're going to need millions to be able to retire in the future. Not just, you're not going to have these pensions and everything that give us steady flow of income. You have to create your own by what you built in a lifetime. Yeah. The only way to get there is save small, save often, save from the very beginning, keep it going.
The one way I like to look at it mentally is like a Roth is 100% yours.
Yep.
Your pre-tax, it depends on who you are, but we'll just call it somewhere in that 70 to 80 range-ish. The rest belongs to the government. And they're going to get it at some point, either during your life or 10 years after you die.
Yeah, you're sharing. So a Roth IRA, we love them. How can you get money in there? We've talked about contributions based on earned income up to an income level. When you're over that income level, or if you're not working any longer, or if you have 401k rollover money that's gone to an IRA and you just want to look at something of how to get it to a Roth, how does one get IRA, pre-tax money, or even after-tax money into a Roth, Alex?
So what you do is you pay the tax. It's called a conversion.
All right,
and that's where you take something that's pre-tax, just for simple sake. We'll say it's 100% pre-tax. You've never paid a dime on it.
Sure.
And then wherever that money is, it's going to be something called a conversion or a Roth conversion form, because like you said, once you do it, you can't go back.
Yeah, we call this Roth conversions. That's the term, but I also call it you're Rothifying it. Your Rothification process. You're really bringing Roth into your personal planning.
I think you're taking the Roth word and making it a verb.
Well, I believe it is an action. It's a painful action. You got to pay the tax now, but once you pay that tax, you don't have to pay it again. And I love that. Pay tax now, never again. That's a thing.
And my favorite thing, and is to show somebody, hey, here's where you are right now. Mm-hmm. This is your current tax bracket. You can have this much more of income this year, and your tax bracket doesn't change.
Yes. So tax bracket planning is about levelizing your taxes this year over the years to the future.
Right. So we're not just saying, hey, you have pre-tax stuff. The second you come in, we're going to pay tax on it all. That's not the case, right?
Yeah. So everybody needs to understand that the federal tax rates are like steps, going up steps, and there's these steps of 10 and 12% currently, and then there's a big jump to the next one, a 10% step. It goes from 12 to 22.
It's like those awkward steps where you have to take 2 steps on one.
Then you like jump, or you fall into them if you're trying to race up.
Your whole
back in the day
rhythm flows off. Yeah.
And then there's another bracket to 24. 22, 24 is not a big deal. When you go from 24 to 32, right?
That's a big deal.
That's a big deal. Now, we're talking about the TCJA, Tax Cut and Jobs Act of 2017 tax law.
Correct.
After the 2024 election, that's going to make this, basically this tax law, they're going to work towards making it extend and not sunset and end at the end of 2025. And so these brackets that we're talking about, the 32, the 35, 37 being the highest, could become a more permanent law or extended out. Right now, we would say that that's more in the future. It's not something that's known.
And they've changed tax laws on us when we're in a tax year before.
Retroly, yeah.
Like,
back to January 1st.
Guess what?
Yeah. Well, the idea is that there's tax brackets, it's steps. There's one gap that's a 10% jump. Then there's a 24 to 32% jump. So when you're doing Roth conversions and you're looking at, well, how much should I convert? You got to look at where you're going to be tax-wise your whole life. I have clients that are always going to be at the highest bracket forever, always 37. And my thing is, well, how much can we afford to convert? Can we do $500,000?
Right.
Can we do $1 million?
Especially if you have cash that's sitting there earning interest that you're paying tax on at 30%, where you can trade that for taxed never money. That's a good deal.
Especially in the high net worth, I believe Roth and Roth conversions is a very big deal. Yeah, the high net worth, they have the concept where they're going to be in a high bracket their whole life, almost half their money between state and federal, and everything else goes to taxes. And then it comes. Yeah. But it comes down to lifetime of taxes. Is Roth conversion really the best decision for you and for the legacy of your family? Yeah, it's not an easy topic. It's an individual topic where you got to look at your tax return, do a tax estimate. You got to see where you'll fall, where your bracket is, what bracket are you in, and then how much to fill up that bracket. We're not really big into paying more than you ever would in your lifetime.
Yeah, I don't want to pay taxes just for the sake of paying them.
Yep.
Because I think there's a sweet spot where you can feather out that IRA money and you have some showing as taxable each year.
Correct.
It allows you to do other things like gifts to charity, et cetera.
Yep.
And you never know what the future tax laws are going to be either. So,
yeah. So generally, we believe long-term tax rates will not be as good as they are now. We think they will ultimately go higher. But the concept is that if you let your money keep growing, you're going to pay tax on more money. And the more money you have under the income tax means that it's not all your money. That's a key ingredient.
My favorite thing to do is levelize the taxes. So at 73 to 75, you have required minimum distribution. And if you're taking your required minimum, you can't convert that to Roth.
Absolutely. There's lots of rumors of how tax laws and things will change over the next year. I usually don't worry about those until they become the law. And so right now, under tax law, we think Rothification, Rothifying your money is a good idea. Roth conversions are good throughout your year. They have to be done by 12/31. Most investment companies want them done by the middle of December.
Yeah, they're like, hey, for year-end closing, we're going to need everything by the 5th day of December. It's like, what?
The best thing to do is to have logistics on how they actually do it. I like having an IRA and the Roth at the same custodian, which is a place you hold it, like a Schwab or a Fidelity or anything like that. And you can actually convert one to the other very simply.
And you can do it in kind, meaning you pick an investment, say, hey, I like that stock. It's down a little bit this year. I want to have 10 grand more of income. Let's pay the tax on it now. Hold it forever.
Yeah, so in kind is where they actually journal the stock. Let's say 100 shares of Tesla.
Journal, just move account to account.
It's in your IRA and it's over there. The value on the day of the transfer is the taxation that you're going to 1099-R for. That 1099 will come into January. When you convert, there's no penalty to convert. There's a penalty if you convert and then pull it out thinking you're being cute. But the idea is
they thought of that?
Yeah. Yeah, they make you do a 5-year rule on conversion. To be able to touch your conversion, you have to track that on the special 8606 form, which is all about the documentation of what you're doing. So the idea is this. Logistically, we think having an advisor guide you through it makes sense. Roth conversions make sense. Many times you cannot do Roth conversions at your work, but some larger companies are now beginning to allow you to do that.
And eventually, that's where the law's headed. But these plans have gone through so many changes. I mean, 5 years ago, I don't think you had Roth 401ks.
Correct.
So just the logistics of how they have to manage it, and, it's a lot of work.
Yeah, we did it with a client at the state of Maryland. We did a Roth conversion at the work. The rule used to be where you had to roll money out of your 401k to an IRA. Once it got to the IRA, then you could convert it at that time. And so there's more choices. So finding out what your plan can offer and seeing what's best is very, very important.
Yeah, and finding out why am I going to pay taxes this year? Does it make sense for me? Am I shooting for a tax bracket? Am I shooting for a Medicare income limit? What's my goal? What am I trying to accomplish? And that's my favorite part, is taking your life and putting that puzzle piece together with the financial part of it.
Yeah, so the concept is pay tax now. That's a Roth IRA. You pay tax now, save this money, grows tax-free, comes back to you. The design is to come back to you when you're not working, when you need this money to work for you. So what we're talking about is planning, proper planning through Roth, examining your portfolio, your taxes, and we bring this all together to build a plan that will help you with your lifestyle and how you want to do your planning. We love doing this. We love planning for levelizing taxes. We love making sure that taxes are not a major expense in your retirement years. Yes, we like the idea of zero tax, but probably not really targeting a zero tax. We want the lowest tax without going all the way to zero, because that means you paid it all sometime. And I'd rather levelize your lifetime of taxes over time. So the idea is this. We help people do this. It'll be taken care of at Akers Financial Group because we plan for this, and you're going to be okay. At Akers Financial Group, we want you to consider talking about your retirement money and what makes the most sense inside of your financial fingerprint. This retirement plan is going to be based on you and your unique fingerprint, and that determines where your money goes, how you invest it, how you pay tax, and when you pay tax. It's not about us. It's going to be about you. So give us a call at 833-WIN-RETIRE. Schedule an in-person meeting with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-946-7384. Or go to our website, akersfinancialgroup.com. If you're married or single, it makes a difference. We'll explain in the second half of Winning in Retirement.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back indeed to Winning in Retirement. This is Brian Akers. We set up this show, Winning in Retirement, so that you can think about winning in your future retirement, so you can think about winning in your current retirement. But the idea of winning in retirement is subject to the person. Now, Alex Monk is our co-host here. I want him to tell us all about winning in retirement. What does winning in retirement feel like, Alex?
For me, I'm not quite there yet. But to give you an example.
Yeah, what does it look like?
Some people play pickleball. Some people move, travel. And it changes too, right? Like the first couple of years of retirement and then, like the mid years of retirement. And it's always different. Like it's hard for me to say. Like I give people crazy examples just to tell them, hey, I don't care how you spend your money. I just want to make sure you have the most amount available to spend.
And whatever you want to do. And then understanding what you want to do, I think is a key part of retirement is what is winning in retirement to you. Now that we have shows on that. Now the reason we talk about that is when you think about saving and investing and paying tax now or later, you are investing in your future. Roth conversions, Roth ideas are very important for the long-term future. In this quarter, we're going to cover a subject of if you're married or single, does it make a difference in Roth planning? One of the biggest things we're going to cover is the idea of being married and then becoming suddenly single when one of the spouses pass away. And why a Roth IRA, while you're married, before anything happens in the family, can be the reason why you need to do it now rather than later.
It is absolutely the biggest area of concern for me is because a lot of times two people, you go to one, the income doesn't get cut in half immediately.
No, it gets cut down some, but not some. A couple thousand, maybe a month, if we plan right. But the idea is the money's still there. We still got to take it out. The RMD calculation gets redone.
Right. It all becomes that person. So now we're in essentially the same income level.
But not the same tax bracket.
And the tax brackets get cut in half. Your standard deduction gets cut in half. So there, it's like, what just happened?
Like just a quick example, someone that makes, say, $100,000 as taxable, that's after deduction, that puts them just into the beginning of 22% as a married filing jointly. But that puts them into a 24% in single, but the single actually starts their 22% bracket at $47,000.
Yeah, I mean,
so they go from 12 to 22. They basically pay double the federal tax because of the way they file. So if
there's no way around it,
the year that your spouse dies is the last year you file jointly, and when you file jointly and basically post-death planning that year, we try to do Roth conversions maximum we can before the bracket really drops on people. So the concept of Roth conversion, I'll do it later in life. The question is how much time do we have? If you are married, I think the idea is to consider Roth conversion as much as you can now before we get to that point.
Yeah, as much as possible, because at some point, unless you both pass at the same exact time, there will be a day where essentially your taxes are going to double.
Absolutely.
For either you or your spouse.
Now, if someone's just single, they've been single their whole life, and they're successful, a very good planner, I think a Roth IRA makes a lot of sense because of the fact that you get to higher brackets very early. So if you have a couple $1 million, say $3-4 million, all of a sudden your RMD is $120, $150 a year. At that, in the single brackets, you're sitting in the right near the 32% level. At just at $190,000 is where you're at 32%. So between Social Security and any of your savings, you have a few $1 million saved. All of a sudden, you're going to wish you had Roth.
Yeah, and especially you said like, oh, your RMD is going to hit. So not only does that happen, but it can also trigger other things like your Medicare can go up.
Yeah, that's called IRMA. The Medicare premium actually increases if you make too much money.
And if you don't have a way around it, right? If we don't start this process of withdrawal and paying some type of tax, your RMD is not going to go down. Your required minimum will still be as big or bigger in the future.
Yeah, the IRMA right now triggers at about 108 for a single person, 108,000 a year.
Yeah, it's like what, 206 or something?
216 for 24 income going into 2026, 2025 income. We're thinking there hasn't been an official number for that yet, but it'll be indexed higher. The hardest part when it comes to planning is we don't know all the future. We know that if you're successful and doing well, that you need to consider Roth anywhere and everywhere that you can. It's painful to make the commitment to paying the Roth. I have to get clients to a point where I explain to them, you're going to be in the same bracket when you retire or higher. Once you have that assumption, then the Roth makes a lot of sense to Rothify your life for Rothification, where you figure out a way to do it. Roth contribution through work or on your own, or backdoor Roth, or Roth conversion on an annual basis based on the bracket that you're in.
I just want to be in the meeting where you just slip that Rothification in or Rothify.
Any day, every day.
Do people flinch, or are they like, what did he just, what?
Once in a while, they're like, what is that? But most of the time, they're with it. I lean forward and I say, how about an account that's going to be tax-free? And that sounds great, but you got to pay taxes on the way in.
I always tell people when it's like our year-end meeting and we're seeing how much money they made, I'm like, how you been? How much tax do you want to pay today?
And they're like, oh, what do you mean? I want to pay millions. I want to pay the lunch.
We're going to decide today how much we're going to increase your taxes today, but intentionally, so that if we can just do like a little bit of planning, right, for 5 years before required minimum, and we can cut your RMD in half, or we can do so many huge things with a couple of years.
I want to talk so badly right now because I have this client I just met with. When his wife passed away, all of a sudden, all their retirement plans are all his. It's $5.8 million in retirement money, all pre-tax because they're in their later 70s. And I'm talking to a family meeting, the spouse, the widower that's left, and the kids. The kids are actually at the same bracket as the father, or one son's actually at the highest bracket. So this $5.8 million is going to be taxable to all of them at some point in time. And so the reality is, should the father Roth convert and pay tax at his bracket? And there's a way that through charitable giving that we can basically run his bracket about 8% less than the son's brackets. And so this type of planning is where we're paying tax now because of the legacy planning and because pulling money out of the IRA reduces future required minimum distributions, because Roth, you don't have to take the money out while you're alive. What we also were trying to plan for is another catch in Maryland, and that is Maryland inheritance tax for a single person is at $5 million. So imagine all these hoops we're trying to juggle. And we also have the hoop of IRMA, but IRMA is for single. Once you get above like 130, it always goes $500,000 of income a year, and you're at the same amount of premium. So it really doesn't change that if you really pump a lot through. So this is just this scenario of these are all the options. That took me 45 minutes to explain all the options. And then they're like, well, what do you want to do? I said, well, let's begin by having a basic Roth conversion this year. We'll get into it next year. Maybe we'll try to do a big chunk. Big chunk to me is $250,000, something like that, trying to slide it over. Because I was trying to teach a topic called estate freezing. Estate freezing in a great stock market year when your portfolio goes up 20, 30%, all of a sudden you create more of a tax problem because you make a $600,000, $800,000 profit inside the IRAs and it's going to be taxable.
Wouldn't you like that growth in your Roth?
We want it in the Roth if we can get it there. So the concept, the real true concept is if you're picking your investments, make your stocks inside the Roth. Don't be having your fixed inside of a Roth. I don't like fixed annuities in Roths. I don't like fixed CDs in a Roth. I like stocks in the Roth. I like CDs and fixed income and IRAs.
So you're telling me you're going to pick different style investments per account titling?
Absolutely. We're not going to have the portfolios all managed the same way. We don't have one portfolio like you just draw up and say, here, take portfolio one. That's all we offer.
I see so many people come in and they have some wirehouse guy that's got all 6 of their different accounts all in the same thing, and they got bonds in their taxable account. And
yeah.
I just look at it and I'm like, this guy's getting paid how much from your accounts? And he's put either he's not smart or he hasn't spent the time to look.
No, there's so many answers to what you just said. My issue is like, let's say you're in a 401k plan and you have Roth money, after-tax, pre-tax money, and you pick target date for the same ones. Well, why should you be in a low-risk target rate for your Roth money when you're not going to technically use that money, the other piece? And I don't love target date funds, but if that's your only choice, we got to work with it. But the idea is this. I think Roth investing is very important to make it right. When we're talking this married versus single and family planning, legacy planning, work all the variables together. I know it sounds confusing. The main thing to learn is a financial advisor sits down with you, takes a scenario, projects out this tax, works through the scenario with you, your scenario, and comes up with what's best in your case.
Yeah, and usually like the way I like to present it is, all right, where's our hot button, right? Do we want to shoot for a tax bracket? Do we want to shoot for a Medicare limit? Do we want to shoot for, I got a $60,000 vacation to pay for? Like, Life comes first.
Oh, I had that too this week. The client goes, Brian, I don't want to do a Roth conversion this week. We want to this year. We want to travel. I said, all right, that's great.
Then I love that, right?
Because we need to know your goal.
Pay the tax, memory invest.
Absolutely. So we're going to pay the same tax if you use the money or if we invest it long term. So I love when we have purpose for our money. Purpose for our money drives investment philosophy, risk and tolerance. It drives how we invest the money. It works.
I don't know.
Yes, I get fired up with this topic. I think it's an incredible topic.
It really is. I don't understand how people do their job without knowing. Like, I need to know everything before
Well, that's why planning is what matters, and why if someone's just doing investing without asking you a tax question doesn't make any sense. So being fiduciaries is very important to understand the full client situation to get the answer to where you totally implement. And what happens is you ultimately get to retire and enjoy your retirement. Those first few years, you're sort of figuring it out. The best thing you know is you got your time back where you decide how to use it, where no one else is telling you what to do because you're retired. And the key thing the first couple of years is not to tell anybody else because they might volunteer you for something else. Yes, we give lots of retirement advice, but guiding you into those years is very important. It's so easy to begin winning in retirement, just like that. You just go to our website at akersfinancialgroup.com, scroll to schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or call us at 833-WIN-RETIRE, 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Warning, when it comes to a Roth conversion, don't try this at home. We'll talk about that in the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. The fourth quarter, it's winning time. It's actually winning in retirement time. We invited Alex Monk to be our co-host today, and he's over there in the corner ready to go in the fourth quarter. I know I was pumping in the third, trying to get my lead going. Wow. I love implementing Roth inside of a plan, especially when I can see the long-term effect for a family. It's exciting to help people in that way. It's a great thing.
And I get like so excited when I'm like, look here, let me just explain to you what we've just done. And the people are like, that's great.
Well, the coolest thing is if the family's not involved is when you're doing Roth and Rothification and then they pass away and you tell the kids, well, this chunk of money is your money. It's tax-free. You can take it out whenever you like. We have 10 years to decide how to take it out. You need to come back and do your own planning to decide what's best for you. And almost all of those kids come back and we sit down and guide and teach them how to make things like their parents did so that they are good and their legacy is good.
Yeah, and the legacy is so important because when you pass stuff on, you don't want it to be a burden. Now, if you gave me $100,000 and I had to give 20 of it to taxes, I wouldn't call that a burden.
No, but if you get $100,000 added on top of your other income, and all of a sudden everything gets taxed higher,
right?
And it's like, good grief, this taxes is killing me.
Oh, and it hurts. Like paying taxes hurts, especially when it's not on your terms. Like I want to be the one that says, hey, okay, this is the time we're going to pay some tax this year. Not, oh, the roof blew off. I need to take out $100,000, which gets you to $150,000, which gets you to a little bit more, a little bit more, a little bit more. So it's the legacy, there's so many things. It's just so much fun.
Yeah, so the idea of Rothification, that's where you pay tax now on your IRA, your 401k, pre-tax money. By pulling it from a IRA to a Roth IRA, so a Roth 401k, a Roth TSP. Converting that means paying tax now and never again. It's tax-free to you, to your spouse, and then to your kids. They'll have 10 years to take the money out. The only other thing that provides tax-free is going to be life insurance. This show's not about life insurance, but life insurance is another way to have tax-free benefits for your family. They get a check that's 100% theirs. Now, Rothification, Rothifying your money, the Roth conversion has some logistics to it that we want to give you like a warning sign for here in the fourth quarter. We're going to dig a little deep into the 8606 form.
Well, I'm just happy this is on a Saturday because I know there's some people cruising around the Beltway just trying to get home and hit convert.
It could be Sunday too.
They're like,
whatever day they want to listen to it.
I'm happy because
you can go to our website at akersfinancialgroup.com, hit the radio podcast, and listen to it anytime, any day, any moment.
Yeah, like if you're feeling a little gun shy before you convert, just call. But in reality, it's a big deal because you can't go back. Like an IRA distribution, I got 60 days. I can put the money back. Mm-hmm. I can undo that. I'm not so nervous around those decisions. But a Roth conversion, you're done.
Yeah, so we have it where we set up an account. The account, we have an IRA and Roth, same custodian. When we decide in a meeting to convert, I can tell the operations department, go ahead and convert. Say, let's use the number 100,000 and tell them what to convert over, and it's done. I can actually set it up where we can do conversion year after year with no signatures, but it's still done when somebody says go for it. And so we can't get a redo.
There's no, like, even with a stock trade, you got 2 days. If you, just in case the worst happens, you can change it. But this one's kind of like, this is your one shot. It's like drilling into glass.
All right. So the form 8606, can you, as an accountant or accounting major, you're not an accountant. I'm sorry. I didn't mean to call you that.
Guy.
You're a certified financial planner with an accounting degree. 8606, what's the basics, the purpose of that form?
So the 8606 tracks contributions to IRAs, Roth IRAs, tracks the deductibility of IRA contributions that you may make on your own. If you have no clue what I'm talking about, you might just have an employer plan. But if you have an IRA, an individual retirement arrangement on your own, some years you might not be able to take the full amount that you put in off your taxes.
So that becomes an after-tax contribution to your IRA.
Right. So
and you got to track that cost basis on a form. So the 8606 is filed for the taxpayer and then possibly the taxpayer's spouse. 2 separate forms you have to do. Yeah.
Now, if you do this with your tax return every year, like as your preparer says, hey, do you put any money in an IRA? It probably is already there, auto-populated. But when you said cost basis, that is money that you already paid tax on. Mm-hmm. Like that's one you want to hold on to, right? You don't want to pay tax on that money again, so you got to track it. Now, if you haven't been tracking it, you got no clue, 8606, can be filed on its own. So if we ever find clerical errors,
we found that many times where we had to go backwards and get it filed, especially when people were doing tax returns on their own. They didn't think it didn't matter. Basically, it's not deductible, so it didn't matter. Well, it does matter, because when you withdraw a money, that withdrawal goes through the 8606 form to get the cost basis against the withdrawal, and that could be it's a prorated based on your IRA values versus the cost basis values, and you get proportional taxation. It's a concept where if you don't have the form out, you might actually put money in after tax and then pay tax again on the way out if you don't do the paperwork right.
Yeah. And it's like, wow, it sounds really confusing. And it might be, but that's what we do, right? Like, we'll put the form in front of you and say, okay, this is what it should say. This is what you did. Here's what's happening. Now going forward, here's our plan to clean it up. Like, I had a client, he was putting money in an IRA for 13 years with his old broker.
Yeah.
And they didn't deduct any of it.
Yeah. And they never did the form either.
Never did the form. So once I figured that out, we had to refile the form, keep all the money at his work plans until he retired. We converted the other account and had all the money at work plans, so it's not in that pro rata calculation.
Yeah.
It was just a nightmare, but I'd rather go through all those steps and pay tax twice.
Absolutely. Now, there's a concept called a backdoor Roth.
Oh, gosh.
And this is a little more complex, but we're just going to cover it because it's the use of the 8606 form. So let's say the person's 55 years old. They make more than the limit to contribute to a Roth or deduct their IRA. So they still can put an after-tax IRA, so with no income limit. So that means if they're over 50, they can put probably around $8,000 or so in. That $8,000 goes in. That money is after-tax money. That after-tax cost basis, you track it on your 8606 form.
Yeah.
And when that goes in, you have an account with $8,000. It's an IRA. If you then, at the next day, convert it to Roth, you'll get a 1099 on that taxable event. That taxable event will show as income. That income comes to 8606. It looks for cost basis. If you had a cost basis of 8, all of a sudden 8 minus 8 equals 0, and you pay no tax on the conversion because you had a cost basis. So backdoor IRA is for high income earners, the ability to create some money to a Roth. This works very well if you don't have any other IRA to mess up the cost basis calculation.
Yeah, I would say no other IRAs typically is the best.
If you have an IRA, don't do a backdoor Roth. A backdoor Roth is definitely another warning sign. We love doing them when we can, if we can make them fit, but there's certain criteria. The main criteria is you don't have an individual IRA at all. The year you retire and roll your money out, you got to stop doing backdoor Roths. But the backdoor Roth is something for high income earners as a way to get a little bit more money saved for you and your spouse.
Yeah, and like you said, life insurance is another option, but that takes planning too, right? You can't get life insurance when you're the day before death.
Now, life insurance, if you're trying to build up cash value for retirement, you need to start before 45, in my opinion. You need 15 years to let that thing grow because of all the costs inside.
At least.
And life insurance cash value has put money in after tax and it grows tax-free if you take it out properly. But you also want it to grow, and that's why designing the proper policy is very important. We've had to fix poor designs of people that have done this or been sold life insurance in that manner.
I mean, the sale, the idea of it's fantastic, but you got to make sure that the logistics match that because there's a cost to insurance. So it's that fine line of lowest cost of insurance, highest cash value. Mm-hmm. And that's another route. And some people believe life insurance is the only way, Roth's the only way. I think you should use any of it that fits your scenario.
Absolutely. So the concept is this, is that by knowing your tax bracket, you then can make tax decisions that affect how you save your money. Ultimately, your future self is going to be in retirement. And yes, you got to pay taxes in retirement, but we don't want to pay too much tax. We don't want to make a decision now that's going to cost us a lot of tax in the future and actually be at a higher bracket in retirement compared to where you are while you're working. And so the concept of put your money in the 401k, you make less in retirement and you'll pay less taxes is not a concept that we found that's actually happened for our clients. They've been successful, saved their money, and then all of a sudden the taxation is actually higher if we don't have the Roth.
Yeah, it's unfortunate because once you get to that point, you can't do anything.
It's hard to do anything about it unless you have to bite the bullet, pay some taxes, give money to charity is one of the ideas, is how to bring it down. But it's also have to have the ability to meet your income. So Rothification is a process of you looking at your portfolios and can you be Rothified?
Yeah. And then I like to tell people, if I'm helping you through this, the worst decision that you're going to make is you paid your taxes in advance at a level that you knew about. And
never again is the key thing. The hard part, if you need the money a couple of years later, it's not a bad idea. It's just it's not the best idea, because the more you let it grow, the better the situation becomes.
Right. And if there's really no immediate plan to use it, then put it in the Roth, let it grow tax-free. And if you need it, it's still there.
I like the idea when we're trying to stay under IRMA at retirement, which is the Medicare premium means tax. I can take money out of the Roth and it doesn't count. And that helps us balance out withdrawals. If somebody says, "Oh, I'm going on a trip, I need $10,000 right now," type thing. These are all very important topics. Thanks very much for a good show, Alex Monk.
I can't believe how jazzed we got on this one.
Well, if somebody had to have a reason to come meet with us, I think Rothifying is the reason. That's a great reason to get started, and let's see how it applies in your situation. So today we covered Roth. Make sure you go to our website, check us out, AkersFinancialGroup.com. We do look forward to meeting you. We want you to win in your retirement by taking advantage of the opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at AkersFinancialGroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule your free meeting. That's AkersFinancialGroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting with one of our team of advisors. Start planning for your retirement now. Go to AkersFinancialGroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Arcadios Capital, an SIPC and FINRA member firm. Advisory services are provided through Arcadios Wealth. Akers Financial Group and Arcadios do not share any common ownership. Neither Arcadios nor Akers Financial Group provides tax or legal advice. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.